This is the first segment for Section 2. In managerial finance, we're going to be discussing first accounting and reviewing accounting and statement of cash flows, financial and ratio analysis. Then we'll move into time value of money, and then finally we'll assess risk. But all of this in this course really comes back to a very central idea, and the idea that's at the foundation of finance is just this rearranging of cash flows. We're exchanging a single cash flow for a series of cash flows. So you may have done this when you've got a loan or purchased a home or a car. These are what are called mortgages, where the loan is backed by some collateralizable asset. Or you may have done this when you purchased something. Either you retired a loan, paying off a mortgage, selling securities, or purchase some type of investment. This reverses that cash flow. We need to convert these future dollars into present dollars because a dollar tomorrow is worth less than a dollar today. And we're going to be doing that in the time value of money section. But as you think about this rearranging of cash flows, it really requires this guess, this estimate about the future. So you have to, in a sense, speculate. And I want to clearly define that speculation is different from gambling. Speculation can sometimes have a bad meaning, but speculation means that we have some uncertainty in the actual outcome. So we don't really know if we're going to get our money back or what the return will be. But on average, the outcome is positive, on average. Gambling, however, has a negative expected outcome or a negative expected return. We know that because Vegas is lit, and you have a lot of people that spend a lot of money there, and they are funded by the losers. So when I go to Vegas, I know that there's a chance I could win. There's more likely chance I could lose. But on average, you take everybody in bulk and add up the winners and the losers, and on average, you're going to see that it's negative. So speculation has a positive expected return. An investment in a stock market or a stock or a company has a positive expected return, whereas gambling has a negative. Both speculation and gambling deal with uncertainty. Uncertainty in finance is called risk. Financial managers need to identify risk. They need to identify where are the risks of the cash flow. Will this person pay me back? Will this investment give me the return that I want? You need to assess that risk because you need to find out how much of a return you would expect based on the risk, and then if possible, mitigate some of that risk. Now, we'll be using the term security quite a bit in this course. And what really is a security? A security is a financial asset. A financial asset is basically a piece of paper that says you own something. So the term security is defined broadly to include a wide variety of investments, sometimes called stocks, bonds, notes, debentures, limited partnerships, gas, oil interests, investment contracts. It's just all kinds, but it's a financial asset that is backed by some real asset, either tangible or intangible. Prior to this course, well, not necessarily prior to this course, you may still have to take a business law course in the future, but I want to review what you've already learned or will learn in that business law class, because it's important when we talk about financing and the cash flows that will occur depending on the different type of business structure that you have. There are three principal types of business structures, and we can make them more complicated if we want. The first is a proprietorship. You are a proprietor. You have a social security number. You are a proprietor. Proprietors are nice because they're easy and inexpensively formed. They're subject to few regulations, and you complete a tax return every year, and you are taxed as an individual. Now there's some limitations. You have unlimited personal liability, which means that if you run somebody over in your car, you are personally liable for everything you own. Your life is finite, meaning you will die, and you cannot transfer ownership. Transferring ownership of a proprietorship is slavery. Slavery is not legal. So financing is limited to banks, limited to friends, families, others that are willing to invest in you, but you cannot divide up the shares and sell them on a public market. Now, if you bring somebody else in, you've somewhat diversified or spread the risk, but you really have the same advantages. Formulation is easy, regulation is minimal, tax like an individual, limitations are similar to a proprietorship. So, given the limitations primarily of finite life and limited and unlimited liability, the corporation was formed. And a corporation acts, at least in a legal sense, like an individual. It has a birth, but it has no death. It is a nexus of contracts. It is where the suppliers and the employers and the customers and the state come together and agree that this is an entity. This entity has an infinite life. You can divide ownership, and the most importantly, it has limited liability. Limited liability means that if you invest in a corporation and that corporation does something really bad, the most you can lose is the amount of your investment. You are not personally liable for the actions of that corporation. So you can separate yourself legally from that investment. Because you can do that, it allows financing opportunities to really expand. Because now that I can invest in a corporation and I'm not personally liable, I am willing to invest more, and I'm willing to buy shares of stock, buy debt, and that debt and stock can be sold in public markets to tens of hundreds of thousands of millions of people. Now, the disadvantages: contracting and maintenance is difficult. You have to be organized according to the laws in the state that you are operating in. Typically, you need to hire an attorney. And then while you are existing as a corporation, you have to make sure that you're following the bylaws of that corporation to remain a legal entity. Earnings are subject to double taxation. What does this mean? Double taxation means that the corporation is first taxed. Then, when the earnings or the income is distributed through the form of capital gains or through dividends, it's taxed again at the personal level. Now, there are some limitations within the tax code that allow individuals to shield some of those taxes, but corporations do have that primary disadvantage. So, how do you create a corporation that keeps the advantages but reduces the disadvantages, primarily the double taxation? These are called S Corps, LLCs, and LLPs. S Corps are probably the most common. They do have limits on how many people that can invest and how much you can divide the shares, but the primary advantage to an S Corp is that it is taxed as an individual, so it is not subject to this double taxation.